My name is Farhan. Today you are going to solve question number 3 from 2018 past exam. This question requires you to reconstruct three ledger accounts, accounts receivable, accounts payable, and inventory. You're also required to prepare the cash flow statement. This question has many complications, so make sure to follow through and focus throughout the entire content. If you want to answer your VCE accounting examinations in November, make sure to check the link in the description to book a call with me. With that being said, let's get started. Dynamic Traders is preparing its cash flow statement for the year ended 30 June 2018. The income statement for the year ended 30 June 2018 showed the following. So we are given the sales of $480,000 and the gross profit of $180,000. We know that we can calculate the cost of goods sold by simply subtracting the gross profit from sales. So if the sales is $480,000 and the gross profit is $180,000, then the cost of goods sold is $480,000 minus $180,000, which is equal to $300,000. So we're going to be using this number eventually. Net profit was $61,520 and we're given some expenses. You can see that out of all these expenses, we have four non-cash expenses, which are the depreciation of equipment, the bad debts, the discount expense, and the loss on disposal of shop fittings. You can see that we're given the balance sheet as of 30 June 2017 and also as of 30 June 2018. This means the closing balance in 2017 will become the opening balance in 2018, which is the current financial year that we're working with. And that financial year started on 1 July 2017 and ends on 30 June 2018. You can also see some different terminologies that you may or may not be familiar with. So this is from the old curriculum, but the question is very relevant even in today's curriculum as well. But debtors control is what you now call accounts receivable. Stock control is what you refer to as inventory. And creditors control are what you refer to as accounts payable. You are also given some additional information. You're given the ledger account for the GST clearing, which is a liability account and refers to your obligation towards the ATO. You are also given some other information such as all sales and purchases of stock were on credit, all drawings were on cash, and you have taken a loan out on 30 June 2018, and you've also made some loan repayments during the year. The first requirement is to reconstruct the ledger accounts for accounts receivable, inventory, and accounts payable. So the outline has already been given here, and I have solved them for you. So I'll explain you each and every step on what we have done. First of all, we understand that debtors control refers to accounts receivable. So the accounts receivable are the credit customers of the business. These are the people who owe the business money. This means these people are the assets of the business. All assets by default should have an opening balance on the debit side. This means when assets increase, we debit them, and when assets decrease, we credit them. This also means that the closing balance of the assets should always be on the credit side of the ledger account. So I believe you understand that this side refers to the debit side, and the right-hand side here refers to the credit side. So let's start with the opening and the closing balances first. Now the opening balance, as you can see on the debit side, is on the 1st of July, and that's 37,000. And the closing balance is on the credit side at 30 June 2018, and that is $40,000. Now, where do you think we have got these two numbers from? If you guessed the balance sheet, you are correct. So let me take you back to the balance sheet, and you can see that we're given the balance sheet for two different periods, ending 30 June 2017 and ending 30 June 2018. And you can see the closing balance for accounts receivable at 30 June 2017 was $37,000, which becomes the opening balance on 1st July 2017. And the closing balance is $40,000 at 30 June 2018, which is what you have seen we included here within the ledger account. All right, so we have taken care of everything here in the first line. Now, where did we get the figure for bad debts and discount expense from? So both of these items are what we refer to as expenses. So at the very beginning of the question, you can see that you're given the net profit and you're also given all the expenses that we have. So bad debts and discount expense refers to what? Bad debts expense refers to those credit sales that you have made in the past, which you know that you won't be able to collect any cash anymore. This is because these debtors have probably gone bankrupt or they can't pay you anymore due to any circumstances. You can have discount expense, which refers to the discount that you as the business give to your customers for prompt payment, for quick payment. So what we can understand by both bad debts and discount expense is that they're relevant to your credit sales. So credit sales are relevant to accounts receivable. So if we have bad debts and if we have discount expense, this reduces the accounts receivable, which reduces the asset. And when assets decrease, we credit them. So that is what we are doing within the ledger account. So you can see bad debts 1,500 on the credit side written off and discount expense of 800 on the credit side as well, which simply refers to the reduction in the amount that your accounts receivable owe the business. All right. So the highlighted row is what we will calculate ourselves, and I'll come back to that. But what about this on the debit side? For the year ending 30 June 2018, we have included sales, including GST, that we expect to collect from our accounts receivable, and that is $528,000. All right. So let's go back to the additional information of the question. So you can see it clearly mentions all sales and purchases were on credit. So obviously, whatever amount we have for sales, that should only and strictly refer to credit sales. Now, within the GST clearing liability account, you can see on the credit side, we are given the opening balance, and that is $2,000. And you can also see this line, which refers to at 30th of June 2018, the amount that we expect to collect from our accounts receivable for credit sales made during the year ending 30 June 2018 is $48,000. Because it explicitly mentions debtors control our accounts receivable within the credit side of the GST clearing account, this is very specific about the GST that you expect to collect on all the credit sales that you have made during the year, and that is $48,000. All right. Now, on the right-hand side, you can get to see more workings. So we understand that from the GST clearing account, we have got the GST collections from the expected GST collections of $48,000 from our accounts receivable, which refers to the GST for all the sales that we have made for the year ending 30 June 2018. All right. So we understand that 10% of the total sales revenue should give us the GST because the GST rate is 10%. So if I want to find the total sales revenue, you can use algebra and you can simply divide the GST that you expect to collect with 10%. And the GST that we expect to collect is what we have sourced from the GST clearing liability account, and that is 48,000. And then 10% is what we are dividing it with, and we should get $480,000 as the total sales revenue. So sales plus GST can therefore be calculated as the total sales revenue of $480,000 plus $48,000 in GST, which makes it $528,000. Now, could we have ignored majority of these workings? Yes, obviously we could have, but there's a reason why I went through all these detailed steps so you understand how the question actually comes together. So we have found the total sales revenue to be 480,000, and based on the additional information that's given to us, we can confidently say that all the sales were on credit. And you can also validate this $480,000 that we have just derived from the very first few lines of the question, where it explicitly mentions that sales were 480,000 And if all sales were on credit, then the total sales revenue were 480,000, which means GST would have been 10% of 480,000, and that's 48,000, which must be the amount that is showing in the GST clearing account on the credit side anyway. So these are ways which you can use to validate whether or not you are doing right, and you can confidently move on to the next step of the question. All right. So let's go to the accounts receivable ledger account, and you can see on the debit side, I've included the credit sales, including GST of $528,000. Now, why do you think I'm including this line on the debit side? This is because the more credit sales we make, the higher our accounts receivable, and the higher are our assets. And if assets go up, we debit them. That's it. So how do we find the highlighted amount here? So let's just assume we do not have this amount. So this is the missing number that we have to find. So how do we find this number? We calculate everything on the heaviest side, which is the debit side, and which gives us 565,000. And that must be the total on the credit side as well to ensure all the fundamental rules of accounting apply. And then you subtract the two expenses of bad debts and discount expense and also the closing balance, and you get $522,700, which is the missing figure that we refer to the cash that we have collected from our accounts receivable during the year 2018. That is $522,700. So this cash we have collected refers to a cash inflow, which is what we are eventually going to be recording in the cash flow statement. Right. Now, I have also included the opening balance. I've carried it forward as the opening balance in the next financial year, 1st of July 2018. You could choose to do that, but when it comes to reconstruction, you're not really required to do that, but I would suggest you keep doing it all the time. So when you're preparing your regular ledger account, you don't forget to include this. So this becomes part of the practice that you will be doing always. All right, so that's all for accounts receivable. Now let's move to inventory. Now we're going to prepare the ledger account for the inventory, which is known as stock control in the old curriculum. So the first thing we calculated was the cost of goods sold, which I believe you already understand how we have derived it. So we subtracted the gross profit from the sales, and that gave us $300,000. So just a quick recap why we subtracted gross profit from sales. This is because sales minus cost of goods sold, I'm just writing COGS in short, gives us the gross profit. And from the gross profit, if we subtract all the expenses of the business, what we get is the net profit. Right. Okay. So during the year, we want to find out the inventory that we have purchased, which is the amount that we have highlighted here, and that is the missing figure that we will be calculating eventually. Now, inventory is a current asset of the business. This is because we expect to get some economic benefits by selling this inventory to our customers in the future. And the reason we classify this as a current asset is because we want to get rid of all this inventory as quickly as possible and preferably within the next 12 months. Now, the opening balance, because inventory is an asset, is on the debit side of the ledger account on the 1st of July, and that is 95,000. And the closing balance is on the credit side, and that's $101,000. Let's do a quick verification by looking into the balance sheet, and you can see inventory at end of 2017 is 95,000, which becomes the opening balance for 1st of July 2017, and the closing balance at end of 30 June 2018 is 101,000. Next, we are showing the cost of goods sold on the credit side of the inventory account, and that is $300,000, the amount that we calculated just a while ago and also at the beginning of the video today. So the cost of goods sold is an expense account. So why is cost of goods sold on the credit side of the inventory account? Because think about it, cost of goods sold refers to the amount that we had to spend ourselves to bring this inventory into the business before we could sell it to our potential customers. So that is the cost of doing business. So within the inventory account, if we are crediting the inventory account using the cost of goods sold of 300,000, this is just simply referring to the fact that we have got rid of inventory worth $300,000. So that is why it's on the credit side, which reflects a reduction in the total amount of inventory that we have in the business. So how do we find this missing figure? So we find the total of everything on the heaviest side, which is the credit side, and that is 401,000, which must be the total on the debit side as well. And once you subtract the opening balance, you get $306,000, which is what we can confidently say as the purchases of inventory that we have made during the year. Now, why are we writing accounts payable here? The question explicitly mentions all sales and purchases were on credit. So because we can confidently say that this is on credit, we're writing accounts payable here. You would have written back instead of accounts payable if you know that all purchases of inventory were on cash, and that would have made sense, but that's not relevant in this case. Okay, so you can choose to bring the closing balance forward as the opening balance if you want. Again, this is not required during the reconstruction. Next, we have creditors control, which is known as the accounts payable, and they are relevant to inventory in the sense that the more inventory you purchase on credit, the higher your accounts payable are going to be. Now, just a while ago, we calculated that we purchased $306,000 worth of inventory during the financial year ending 30 June 2018. So the GST on these inventory purchases will be 306,000 plus 10% applied on 306,000, which gives us $336,600 in total. And this is the total amount that we owe to our accounts payable. And this is because, okay, I'll get back to this, but what about this GST of 30,600? So this GST of 30,600 on inventory purchases is what you can validate from the GST clearing account as well. You can see that we expect to pay our creditors, who are our accounts payable, GST of $30,600. And why is this on the debit side of the GST clearing account? This is because if this is on the debit side, this reflects a reduction in the amount we owe as GST to the ATO. So the way this is calculated is by first finding the GST that we expect to collect for our sales, and then we subtract the GST we expect to pay for all our purchases, and the net balance is what we are going to owe the ATO eventually. All right, now if we go back to the accounts payable ledger account, so you have seen that we included the opening balance on the credit side and the closing balance on the debit side. The reason we included the opening balance on the credit side is because this is a liability account, and liabilities by default are always credited, which means when they increase, we credit them, and when they decrease, we debit them. Also, within the ledger accounts, the opening balance of liabilities should always be on the credit side, and the closing balance will be on the debit side. So these two numbers are what we have got from the balance sheet that we saw earlier. And you can see accounts payable under the current liabilities section, 50,500 from previous year and 55,100 for end of current year. So these are the numbers that we have included here. Then we are adding the inventory purchases, including GST, that we expect to pay our accounts payable, which increases our obligation, and therefore this is reported on the credit side of the accounts payable account, referring to an increase in our obligation, and that is $336,600, including GST, which is what you have seen we derived here. Now, how do we find the missing balance for bank, which refers to the payment we have made our accounts payable during the year? We just simply find the total of everything on the credit side, which is $387,100, and that must be the total on the debit side, And once you subtract the closing balance of $55,100, you get $332,000, which refers to the cash that we have paid to our accounts payable or our credit suppliers during the year ending 30 June 2018. And this cash that we have paid refers to a cash outflow, which is what we are going to be showing in the cash flow statement. Right? So I've made some few notes here. We didn't have any discount revenue, neither any return outwards or purchase returns, which are what you will normally see in other questions. You can check out in my other videos. All right, so that's how we reconstruct all the ledger accounts. Now, what's next? We are required to prepare the cash flow statement, and we have to prepare the entire statement, and we have three sections. We have the operating activities, and then we have the investing activities, and then we have the financing activities. A few of the numbers were not straightforward calculations. You had to do some workings to get through the complications. So let me show you how you can address a similar question in exam. Right, so first of all, we're going to start with cash inflows, and the only cash inflow in this question is basically the cash that we have received from our accounts receivable. And this is under the operating activities section. I should have included a heading here, so make sure you do that during the exam. So cash received from accounts receivable of $522,700. Where did we get this from? This is what we have derived from the first reconstruction that we have done. Because this is cash we are collecting from our accounts receivable, this is referring to cash inflow and is therefore added here. Then we are subtracting the payments to accounts payable, which refers to the outflow. The payment that we have made was $332,000 based on our workings. Then we are taking care of all the expenses that are for cash, not the non-cash, because cash flow statements strictly include only cash inflows and outflows. So any non-cash items are not our concern here. So we have included wages of $86,500, and that's a negative because it's wages paid, wages outflow. But let's check the numbers for wages here. So the wages expense is $87,000. So just because it's an expense doesn't necessarily mean that we have paid for everything. So this expense refers to the total expenses that we have consumed or we have incurred during the financial year, and out of which some could be accrued, some could be due, and some could be that we haven't paid yet. So we could check the current liabilities section, and you can see accrued wages. So the opening balance is $2,500 and the closing balance is $3,000. So what you have to do is prepare a ledger account for accrued wages. And accrued wages refer to present obligations of the business, which is what we classify as a liability. And liabilities have an opening balance on the credit side and a closing balance on the debit side. So on the credit side, 1st of July 2017, we're including the opening balance of $2,500. And on the debit side, we are including the closing balance at 30 June 2018, and that's $3,000. During the year, we have expense of $87,000, which is what we're including on the credit side. And once you find the total of everything here on the credit side, and then subtract and take it the same total on the debit side, and then subtract the closing balance, you get $86,500, which reflects the reduction in your bank balance for wages that you have actually paid during the year. And this could be including amount that you owed from previous year as well. So $86,500 refers to the actual cash outflow in terms of wages. So I also want to go through something else here. So we understand that accrued wages is a liability account. And if you have wages expense on the credit side of the liability account, how can we generalize this, for example? So if you were to generalize this, so wages expense, $87,000 included on the credit side of the accrued wages. So this refers to wages that you have already consumed, and therefore you're required to pay them. So what we're doing here is we're crediting accrued wages, if we were to generalize them, by $87,000. and we would debit wages expense by 87,000. So what I mean to say is that if you prepared a ledger account for wages expense instead, what you would be doing is showing the accrued wages. Sorry. So if you were to prepare the wages expense ledger account, you would be showing the accrued wages on the debit side. So that is how this works basically. So just to show you quickly how the journal entry adds up, and the wages paid is 86,500, which is what you can see in the cash flow statement here. Now let's calculate the value for insurance. Now, if you check the balance sheet, you'll see that we are given the prepaid insurance, which refers to a current asset because we have paid for insurance in advance for the next financial year. So let's find that amount. So prepaid insurance at end of 2017 was $2,000 and at end of 2018 was $1,000. So on the right hand side of the screen, you can get to see the ledger account that I have constructed for prepaid insurance. Prepaid insurance is a current asset, and by default, all assets should have an opening balance on the debit side. So on the debit side of the ledger account, 1st of July, opening balance 2,000 for prepaid insurance. And on the credit side, the closing balance for the year ending 30 June 2018 is $1,000, which we have just taken from the balance sheet. We know that during the year, we have expensed $8,000 in prepaid insurance, and this amount is what we have got from here. So how do we find the highlighted number here? So we find the total of everything on the credit side, which is 9,000. That must be the total on the debit side. So when you subtract the opening balance, we are left with 7,000, which refers to the prepaid insurance that we have purchased during the year ending 30 June 2018, and that's $7,000. And we have expensed $8,000 and we are left with $1,000 as the closing balance. So let's go to the cash flow statement, and you can see insurance that we have purchased is $7,000. Then we have advertising and interest paid of 10,800 and 2,000 respectively. We do not really have any accrued interest or accrued advertising. So we assumed with conviction that interest expense and advertising expense have both been paid, and which are the relevant figures that we have included here. $2,000 cash outflow for interest paid and $10,800 cash outflow for advertising expense that we have paid. Next, under the operating activities section, we are including the GST paid and the GST settlement. These are the numbers of 2780 and 2000, which we have directly sourced from the GST clearing account. You can see on the debit side, we have paid 2,780 using our funds from the bank. And then again, you also have another $2,000. So this two rows refer to the reduction in the GST obligation that we have towards the ATO, because we have made the payment of $2,780 and $2,000. Now you might be confused, should I just not write GST paid for both? Why am I writing GST settlement and then GST paid for another amount? You could, I believe, you could write GST paid for both, but it's best to show them separately. The reason we call this one GST settlement is because this came after the initial transaction. So I don't think it's going to be a big issue as long as you could give the total of the GST paid as a cash outflow, and you should still get full marks. So we have included both these numbers here as outflows, and once you do all the totals, you find the net cash flow from operating activities to be a positive 79,620. Next, we're moving to investing activities. So investing activities refer to the purchase of non-current assets or the disposal of non-current assets. When we purchase a non-current asset, that is a cash outflow. And when we dispose a non-current asset, we get some cash, and that is referring to a cash inflow. All right. So how do we know if we got any outflows or inflows during the year? Based on the additional information that's given to us, the second line says all shop fittings were thrown out and they were not replaced. Right? So what does that mean? Let's check the balance sheet for shop fittings, and you can see that there has been a reduction from 9,000 to 4,620. Now, this reduction is not referring to any disposal. This reduction is referring to the shop fittings that we have thrown out and we haven't, and those which we not have replaced. Equipment, however, increased by 10,000, which is what's referring to the purchase of new equipment during the financial year ending 30 June 2018. And that is what we're including within the investing activities section for purchase of equipment, $10,000 negative, referring cash outflow. And the net cash flow from investing is therefore only $10,000 negative. Next, we're moving to the financing activities section. So the financing activities section refers to any loans that we have taken out, any repayments of loans that we have made, any drawings that we have made from our owner's equity. So I'll just first start with the drawings here of 77,320, which is a cash drawing as confirmed by the third line here. All drawings were for cash and no additional contributions were made during the year. So here I have a capital account on the right hand side, and capital account refers to owner's equity, and drawings reduces owner's equity because you do not have money for reinvestment, but you're withdrawing that money which you could have utilized as reinvestment. Now the opening balance is on the credit side. Why? Because capital is a category in itself, where we always show the opening balance on the credit side. When capital increases, we credit them. When capital decreases, we debit them. And the closing balance is also on the debit side. So on the 1st of July, on the credit side, we've included the opening balance of 243,100, which is what we have taken from the closing balance for 2017. And the closing balance on 30 June 2018 is 227,300, which is what we have taken from here. During the year, we have made some profits of 61,520, which is going to increase our owner's equity. And we are showing it on the credit side. Instead of writing net profit, we are writing profit and loss summary. And this is mainly relevant to the closing entries that we're required to do. As part of the closing entries, we close the revenue accounts against the profit and loss summary, and we close the expense accounts against the profit and loss summary. So whatever profit we calculate by subtracting the expenses incurred from the revenues earned is what we eventually close against the owner's capital or equity account, which is referring to additional reinvestment for next financial year prior to any drawings that we are making. Next, the drawings is the figure that we have calculated ourselves. So what we did is found the total of everything on the credit side, which gave us 304,620, which must be the total of everything on the debit side. And once you subtract the closing balance of 227,300 at 30 June 2018, you're left with 77,320, which is what we classify as drawings, reflecting a reduction in owner's capital or owner's equity. All right. So this cash drawings is what we are including within the financing activities section of the cash flow statement. And because this is a drawings, this is referring to outflow, and we're keeping this number in negative. All right. Now, let's look into the last line of the additional information, which says the scheduled loan repayments were made during the year. An additional loan was also taken out on 30 June 2018. So this could be a bit complicated for some students, but I'll break it down as simply as possible. Now, I need you to understand some things first. Let's check where we are given the loan here. So under the current liability section, we are given the loan. And then again, under the non-current liability section, we're given another loan. So I'll just highlight those in green. So this is the loan that's given under the current liability section, and this is the loan that's given under the non-current liability section. Now, I want to ask you a question first. So the $4,000 that is a current liability referring to the short-term loan repayment that is due at end of 2017, do you not think this would be fully repaid in 2018 because this was a current liability? So at end of 30 June 2017, the current liability of $4,000 that relates to the loan would have been fully repaid by end of 2018 because that is the whole definition of current liability, which is to pay off all obligations in the next 12 months. And that is what we're referring to by the $4,000 being fully paid off by end of 2018. All right? Okay. Now let's draw a ledger account for loan. And you can see that I've included the opening balance on the credit side. And the very reason for that is because loan is a debt, which is a liability. And by default, liabilities should always have an opening balance on the credit side. So on 1st of July, we have included the opening balance on the credit side of 40,000 and the closing balance on the debit side for the year ending 30 June 2018 of 51,000. These are the numbers we have sourced from the non-current liabilities section. Okay. Now, we understand that during the year, we have taken some additional loan. And if we are taking additional loan, we have to credit it more. And on that basis, this highlighted figure is what refers to the loan that we have taken out and will therefore be included on the credit side of the loan account because this increases our liability. But we also have repaid loans during the year, and that repayment refers to the $4,000 that we included as current liability from end of 30 June 2017. So this loan would have been fully repaid, which would have reduced the obligation. And because the obligation would have gone down, we have to include it on the debit side, which refers to the reduction in the overall liability balance for loan. Okay, so let's assume we do not have this to begin with, which is what we're trying to find out. And we find the total of everything on the heaviest side, which is the debit side, which gives us 55,000. That must be the total on the credit side as well. And once we subtract the opening balance of 40K, we are left with $15,000, which refers to an additional loan that has been taken during the year. Okay. Now, I also want you to understand something else. What about the T account or the ledger account that we can draw for the current liability section of the loan? Now, you might be wondering why we have included $4,000 here when this was the current liability. Because you need to understand that we have a loan which could be repaid over 5 years, but we're also making the repayments every year as well. So every year we are making some repayments, and whatever amount we expect to repay next year at the end of the current financial year is what we classify as a current liability. So this current liability eventually reduces the balance for the longer term liabilities, right? So they're all connected with each other. So the fact that we are paying the $4,000 in loan from the current liability section, that's going to have an impact in the non-current liability section as well, because a part of the non-current liability section becomes current liability at the end of every financial year. So let's do the ledger account for the current liability of the loan. And you can see I've included the opening balance of 4,000 and the closing balance of 5,000, simply the two numbers that we have been provided here for loan under the current liability section. Then the loan, if we were to balance this, we figured out that we have taken out an additional loan of $1,000 during the year. So this additional loan of $1,000 that we have taken out, if we are adding that to $15,000 more that we have taken for non-current liabilities based on our calculations from the previous ledger account, the total loan that we have taken comes out to be $16,000. This is the number that we are going to include here in the cash flow statement account as a positive number because this is referring to a cash inflow. So let me walk you through the two loan components we have here. The loan repayment of 4,000 in negative refers to the current liability from end of 2017 that we must have taken care of already in 2018. And the loan that we have taken of $16,000, which is a cash inflow, is the number that we have derived by doing the reconstruction of the non-current liability loan account first. Then we also did the reconstruction for the current liability loan account, and we found out that we had taken $1,000 on a current basis and $15,000 on a non-current basis, which gives us $16,000 in total as the total loan that we have taken out during the year ending 30 June 2018. And that is what goes here. So once you have all these three numbers in place, you can find the net cash flow from financing activities, which is negative, referring to more cash outflows in financing compared to cash inflows. So we want to find out the net. So we take 79,620 from operations, subtract the 10,000 for investing, and then subtract a further 65,320 for financing. And we are left with 4,300 as the net increase in cash. So I just got lazy here and wrote plus OB. You can write plus the opening balance from 1st of July 2017, which is 4,100, something we have sourced from the balance sheet. As you can see, the cash at bank at end of 2017 was 4,100, which would be the opening balance in the financial year 2018. And then once you add the opening balance to this net increase in cash, you should get 8,400, which must be the closing balance at 30 June 2018 and must balance with the amount that we have been provided for the cash at bank or the bank balance at 30 June 2018 of 8,400. That's how you confidently know your math is fully correct, given that you haven't made any other silly mistakes. And you should be able to score a perfect 20 out of 20. Right? So that's all for today's lesson. I believe you found a lot of value in this content. Make sure to like this video and subscribe to this channel. And I'll see you in the next lesson.